Okay, so here's something that should be really good news, but is actually causing some serious confusion in the crypto market, and I want to help you understand what's actually happening. The Fed just cut interest rates for the third consecutive time this year, bringing the federal funds rate, which is basically the interest rate that banks charge each other for short-term loans, down to between 3.5 and 3.75%, making it the lowest rate we've seen in over 3 years. Now, here's the thing that doesn't make sense. When interest rates go down, that's typically considered bullish for risk assets like Bitcoin and tech stocks, because cheaper money encourages people to invest in riskier assets. Simple as that, right? But the reality is different from what most people expected. Bitcoin is down, crypto markets have been pulling back, and then there is this underlying tension between what should be happening and what's actually happening. So today I want to explain two different scenarios of what's really going on, because this is the exact kind of situation where understanding both sides helps you make smarter decisions about your money. Let me start with the first scenario, which is what I call the straightforward macro view. When the Fed cuts interest rates, especially by a quarter percentage point like they just did, it's supposed to make borrowing cheaper and make it easier for businesses and people to invest money, right? Think of it like this. If you have $1 today, that dollar is worth more than $1 tomorrow because of the inflation, right? So if I can borrow that dollar at a lower interest rate, I am incentivized to borrow it and invest it into things that might give me higher returns, like Bitcoin, tech stocks, etc. The Fed has been very clear about why they are cutting rates. They are concerned about the labor market. When the labor market weakens, the Fed typically cuts rates to make credit cheaper and encourage companies to hire and expand. Lower interest rates also mean that returns on savings accounts and bonds become less attractive, which theoretically pushes money into riskier assets. A 25 basis point cut, which is what we got, is typically regarded as mildly positive for cryptocurrencies because it increases liquidity in the financial system and promotes investment in riskier assets. Additionally, the Fed is also planning to purchase $45 billion in treasury bills monthly starting January 2026, which is essentially a form of quantitative easing. This should enhance liquidity and drive investment into risk assets. The technical explanation, therefore, is simple. Rate cuts are bullish for Bitcoin, and we should be expecting upside from here, right? Now, let me show you the other side of the coin, the second scenario, the one that actually explains what's happening in the real world right now. And by the way, this is where things get really interesting. The Fed is cutting rates for the third consecutive time isn't actually a sign of economic strength. It's a sign of economic weakness that the Fed is trying to manage. When you look at the bigger picture, the Fed is essentially saying the labor market is slowing down, we are uncertain about inflation, and we need to cut rates to prevent the economy from rolling over into a recession. Okay? This is what economists call liquidity transition. Think of it like this. Imagine you are walking across a frozen lake and the ice beneath you is starting to crack. You don't want to run too fast because you might break through, okay? That's essentially what the Fed is actually telling us. The smooth, easy economic environment that supported the markets isn't there anymore. So here's where investor psychology comes into play. When Bitcoin and crypto holders see the Fed cutting rates because the economy is weakening, not because economic fundamentals are strong, they translate it as a warning signal. It's like when a captain lowers the lifeboats before the ship fully sinks. Smart investors are thinking, if the Fed needs to cut rates 3 times in 1 year, what does that tell me about where the economy really is, right? So instead of seeing rate cuts as bullish, they are seeing them as a signal that danger might be coming. That's why Bitcoin has been pulling back even though rates are being cut. The market has already priced in the rate cuts as they were expected. And this is easily proven. According to the CME FedWatch, traders were assigning an 89.4% likelihood to a quarter point decrease even before the announcement. So when the Fed delivered exactly what everyone expected, there was no surprise, no shock to push prices higher. The real story is hidden in the deeper economic data and the fact that the Fed itself is sharply divided. 3 members of the Federal Open Market Committee actually voted against it. This division tells us that even the people whose job is to manage the economy do not agree on what the right move actually is. Now, believe it or not, there is a third scenario to this that I want to add, and it involves human psychology and the current environment of uncertainty. The Fed is also dealing with major leadership changes. Fed Chair Jerome Powell's term is ending in May 2026, and President Trump has already said he's going to nominate a replacement. This definitely creates uncertainty about what the Fed is actually going to do next year. When investors know that the Fed's leadership is about to change, and when the incoming administration has expressed skepticism about the current Fed chair's approach, it certainly creates some kind of uncertainty, to say the least. Now, crypto investors in particular tend to be forward-looking. They are not just reacting to what's happening today, they are trying to anticipate what happens next, and right now, the near-term future looks uncertain. There is inflation that's still above the Fed's 2% target, there is a weakening labor market, and then there is political uncertainty. This combination creates a sell-off environment, especially in crypto markets where liquidity can evaporate pretty quick. Here's the thing though that might actually confuse you, but it's important to understand. All of these scenarios are correct. Rate cuts are objectively good for Bitcoin in a normal environment because they increase liquidity and make investors, let's say, a little bit more greedy. But we are not really in a normal environment. The rate cuts are happening specifically because the economic environment is weakening, not because things are going well. So the question becomes, which scenario is stronger? In my opinion, the scenario that's explaining more of what's happening right now is the second one, the deeper macro explanation. Here is why. Bitcoin tends to react first to changes in economic sentiment before the rest of the market does. When Bitcoin starts pulling back despite positive technical signals like a Fed rate cut, it's usually because smart investors are seeing something that most people haven't noticed yet. The fact that the Fed is divided, the fact that it's already told us it only plans one rate cut next year instead of the aggressive rate cut we saw in 2025, and the fact that inflation is still sticky, these are all signs that the easy money is probably behind us. This scenario also explains why stocks rallied when the rate cut was announced, even though it was expected. Simply put, the market liked the cut, but it also took note of Powell's cautious signals about the future. That's not really bullish for Bitcoin or tech stocks, right? That's actually a sign that the Fed thinks it's done cutting for now and that the economy might be more stable than people think. If the economy is stronger, then we probably don't need more rate cuts, which means liquidity isn't going to keep expanding, alright? Given everything we've learned today, here's what the average Joe is probably doing. Joe is probably not panicking about Bitcoin or tech stocks, and he's also not aggressively buying at the dip, thinking that lower rates are automatically bullish. Instead, he's focusing on a balanced approach. He's holding his existing Bitcoin position because he genuinely believes that Bitcoin will outperform the market over the next 5 to 10 years. The long-term narrative around Bitcoin that it's digital gold, that it's a hedge against monetary expansion, that story doesn't change just because the Fed is being cautious in the short term. But Joe is also disciplined about new capital. He's not putting new money into crypto aggressively right now because he wants to see more clarity. He's also building cash reserves, not because he thinks a crash is imminent, but because he's learned that having dry powder when things are uncertain is usually a smart play. Joe is also diversifying. He's not going all in on a single narrative. He has Bitcoin, he has some tech stocks, he has some bonds, and he has some cash on the side. That mix should perform reasonably well whether rates go higher or lower, whether the economy accelerates or slows down. The key here is not to try to time the exact bottom. Joe is only trying to position himself to benefit from Bitcoin long term, while managing short-term risk. So here's why you need to understand all the scenarios. It prevents you from being blindsided by market moves. When everyone was expecting the Fed rate cut to send Bitcoin to the moon and Bitcoin didn't go to the moon, people who only understood scenario number 1 were confused and frustrated. But people who understood scenario number 2 weren't surprised at all. This is why understanding the psychology behind market movements is just as important as understanding the mechanics. The Fed cutting rates to a 3-year low technically should be bullish for Bitcoin and crypto, but the reason for those cuts, economic weakness, is the real story. And here's my question for you. Do you think the Fed's rate cuts signal that easy money is coming back and we should be aggressively buying Bitcoin? Or do you think the cuts are a warning signal that difficult times are ahead and we should be more cautious? Drop your answer in the comment section below. I'd love to hear what you believe and what actual steps you are taking next. As always, thanks for watching and I'll see you in the next video. Bye.